If you're over 60 and you've saved $1 million or more, I have good news and bad news for you. The good news is, despite what headlines say about needing $3 million to retire comfortably, $1 million can absolutely be enough. The bad news: the way most people structure and withdraw that money means that the IRS usually takes far more of it than they ever needed to. Not because the retiree did anything wrong, but because nobody showed them how retirement withdrawals actually get taxed. Over the last few years, I've helped multiple people transition into retirement with confidence and structure their money in a way that keeps as much of it as possible for them and their families. So today, I'm going to walk you through the 3 biggest tax mistakes I see people make at the $1 million threshold and how to avoid them and what to do instead. And stay until the end, because the third mistake is the one that I even see diligent savers get wrong, and it has a hard deadline attached to it. Before we get into mistake number 1, there's a concept you need to understand up front. Whether or not $1 million is enough for your retirement depends on a few factors, but a huge one is how that money is structured and how it comes out. In other words, 2 neighbors can each retire at 62 with the exact same $1 million saved, the same Social Security amount, and even the same monthly spending. And one of them can pay tens of thousands of dollars more in taxes over their retirement than the other. Same money, same lifestyle, hugely different tax bill. The difference is their withdrawal strategy. So let's look at where it goes wrong. Mistake number 1. Relying only on traditional 401k, TSP, or IRA withdrawals. The great thing about traditional 401k or IRA is that you get a tax break when the money went in. The slightly more annoying detail is that this means every single dollar that comes out is taxed as ordinary income, just like a paycheck. So if your entire $1 million sits in traditional accounts, you've essentially set up for retirement for yourself, where you and the IRS will be splitting each withdrawal. But it gets worse, because the government won't let you leave that money in there forever. Once you reach your required minimum distribution age, which is 73 for many people right now and 75 if you were born 1960 or later, the IRS forces you to withdraw a set amount every single year, whether you need the income or not. Skip it and the penalty is 25% of the amount you should have taken. So let's say that you're 73 with $1 million still in a traditional IRA. Your first required minimum distribution is roughly $37,000. That's $37,000 of forced taxable income landing on top of your Social Security and everything else, whether you wanted it to or not. And if your account keeps growing, those forced withdrawals grow every year too. The fix is having money in different tax buckets. For example, traditional accounts, which are taxed on the way out. Roth accounts, which grow tax-free and come out tax-free, and regular brokerage accounts, which get more favorable capital gains treatment. When you can choose which bucket to pull from each year, you control your taxable income instead of having the IRS control it for you. If you want to get a full breakdown on the ways that you can make your retirement withdrawals as efficient as possible, you can download our free 5 tax saving strategies guide. It walks you through the strategies we actually use with clients to make sure they're paying what they need to and no more during their retirement years. It's completely free. You can download it from the link in the description. Mistake number 2, triggering Medicare IRMA surcharges. This one is a tax that most people won't even hear about until the bill shows up. The income-related monthly adjustment amount is a surcharge added to your Medicare premiums when your income crosses a certain threshold. In 2026, the standard Medicare Part B premium is about $203 a month. But if your income crosses $109,000 as a single filer or $218,000 as a married couple, your premium then jumps. And at the highest tiers, you could be paying nearly $690 a month per person. That's more than 3 times the standard rate for the exact same coverage as your neighbor. And IRMA is a cliff. It's not a gentle slope. Go over just $1 on the threshold and you're paying the higher premium for the entire year, meaning that $1 of extra income can cost a married couple more than $1,000 in additional Medicare premiums. But it gets trickier. IRMA is based on your income from 2 years ago. So the income you reported at 63 determines what you pay for Medicare at 65. This means that a big withdrawal, the sale of a property, a poorly timed Roth conversion in your early 60s can set you up for years of inflated premiums. The fix here is planning your income around those thresholds, especially in the years right before and after you enroll in Medicare. Sometimes the difference between a smart withdrawal plan and an expensive one is simply which account a single withdrawal comes from. If you don't have a clear idea of where your money is held and what your drawdown plan looks like, take the time to think about this. Or consult with a qualified financial advisor who can look at your long-term retirement goals and help you build a plan that matches them. Mistake number 3. Mistiming or completely avoiding Roth conversions. This last tax mistake is one I see so often because once retirees miss this window, it's gone. A Roth conversion is when you move money from your traditional IRA into a Roth IRA. You pay income tax on the amount that you converted today, and in exchange, that money grows tax-free and comes out tax-free for the rest of your life. No required distributions. No tax bill for your surviving spouse or your kids on that money. So why would anyone avoid that? Usually because paying a tax bill on purpose is never fun. And I get it, but for many people with $1 million or more in traditional accounts, there's a golden window where conversions are dramatically cheaper. And it doesn't stay open. That window usually between the day you retire and the day your required distributions begin. Your paycheck has stopped, so your income is low. Maybe you haven't even claimed Social Security yet. For a few precious years, you might be sitting on one of the lowest tax brackets of your adult life. Convert during those years and you're paying tax at those low rates. Wait too long and the required distributions start stacking on top of your Social Security. Your income floor rises and every conversion after that point costs you more. Let's look at 2 neighbors from earlier. Both age 62 with identical savings. This is usually one of the differences between them. One converted their IRA funds steadily throughout their lower income years, controlling the flow of their finances in a way that matched their lifestyle and it minimized their tax bill. The other left everything in traditional accounts until they hit 73, then forced withdrawals, a higher bracket, and IRMA surcharges all kicked in at once. Now to be clear, Roth conversions are not automatically right for everyone. Convert too much in a single year and you can push yourself into a higher bracket or trip the IRMA threshold we just talked about. The size and timing of your conversions matter enormously. So this is the kind of decision you need to map out properly or discuss with a qualified financial advisor. The theme with all of these mistakes is the same. It's not about how much you have saved. It's about how it's structured and how it comes out. A good financial plan can save you tens of thousands of dollars in unnecessary taxes, and the earlier you get the structure right, the more of those savings you keep. If you're within a few years of retirement or you've already retired and wondering whether your accounts are structured the right way, this is exactly what I help people with every day at Golden Wealth Strategies. You can book a completely free call with me using the link in the description, and together we can look at where you are right now, where you want to be, and what's standing in between the two, including whether any of those 3 mistakes are silently costing you money. But now that we've spoken about the importance of correctly structuring your finances, what does that actually look like in practice? And how can you tell if your portfolio is actually as diversified as you think it is? Well, that's exactly what I covered in the last video, so go ahead and watch it here. I'll see you in the next one.